The market has been very volatile recently. It's a dangerous trading market. In today's video, I'm going to give you 3 tips on how to approach a volatile trading market. I will walk you through a few scenarios, and hopefully next time we have volatile market conditions, you'll be better prepared to trade. We are still offering a free 2-hour workshop where we teach you our proprietary methodology of stock selection, where we find the best in-play stocks to trade each day. This dramatically improves your chances to make money consistently and improves your risk to reward. And in addition, in that 2 hours, we go through 3 of the most successful trading setups that we employ on our proprietary desk in New York City. So, if you're interested in learning how to trade the correct stocks with the best risk to reward, if you're interested in 3 great trading setups for short-term traders, click on the link above or beneath the video, and that will take you to the registration page for the 2-hour free workshop, which in no way will interfere with the playing of this video. So today's 3 trading tips on how to navigate dangerous, volatile market conditions are: number 1, have a bounce list ready to go. Number 2, be prepared at any time for a flush. And number 3, know exactly where you will get out even before you get into a trade. These 3 things can keep you out of trouble in volatile conditions and help you be more consistently profitable. So let me walk you through exactly what I mean by each of these individual trading tips. Number 1, a bounce list. So this is something I usually do over the weekend or every few days. As I'm doing my review process for the day, I take a look at some market-leading stocks, market-leading ETFs, and I look at the longer-term charts, and I look at prices that if they come into, I'm going to look for a bounce. And so here's an example of one that I did the other day. It has SPYs on there: Qs, Apple, Microsoft, Nvidia, Netflix, Facebook, LRCX, and MU. An assortment of stocks, mainly tech stocks and some market ETFs, the Qs, which is the NASDAQ. It's a way to play the tech leaders. Sometimes if the market is getting flushed out to longer term support areas, as well as the SPYs. So I probably put this together maybe a week ago. The market was well above these prices. This week, in the last few days, the last 3 or 4 trading days, everything on the list kind of hit my bounce prices with the exception of Microsoft. The other thing that I do on the list is I'll put prices where I'm interested in buying if it comes into those levels. And at the same time, if it doesn't quite get to my levels, or it gets to my levels and I miss the turn, I want to know if these stocks are behaving well or the market's behaving well. So I'll put some levels to consider if it gets above. So I'll give you an example of Microsoft. Microsoft never got to our 97.5, 98, not yet to our potential bounce area, but it did flush after earnings into about 100, 101. And then it started to hold above 104 the next day. So it was potentially set up as a long setup showing into strength. And so that's why I put on the right side. Another example is Nvidia. Nvidia actually bounced the last couple of days from the mid 180s. It got above 92, 93, and today was consolidating above 200. So there's 2 ways of playing this. The most aggressive way, such as myself, aggressive traders are going to look as it comes into these support areas to get long. And I recognize that it might flush through, I might get stopped out. More conservative traders will look for these stocks to test the support area, then get back above an area where it's showing strength, start to hold above there, and then step in and that kind of the wind at your back, that sort of thing. And so that's kind of the list that I put together last week. And so, yeah, they were good. See, Netflix got down in 292. I bought it the other day. It bounced $15, then failed, got stopped out. The other thing is when you put these lists together, when I put this list together, Netflix was probably 310, 315, something like that. And I was looking to buy between 290, 295, closer to 290. It bounced from there initially, $15. When it failed and got below there and I got stopped out yesterday or the day before, my next support area was 275. I recognize that sometimes things will go through these longer term supports that I identify, and then I want to be ready to go at the next support area. So have your bounce list ready to go. And I'll tie this into how we can use it with one of the other 2 tips as well. So always be prepared for a flush. What is a flush? A flush basically is, we've seen this a few times already since the market started selling off. We saw it first when the market got weak below 280. It flushed one day into 270 and it closed above 273 that day. We saw it again yesterday where we were trending down from around 266, 267, very steady. You can see on the 30 or 5-minute chart here, we're going down, and then the volume really started to pick up at 3 o'clock, and we dropped very quickly from 262 to 260, and then you can see the next bar was even more powerful to the upside, and we reversed. And so we want to be ready for a flush, not only to trade the SPYs themselves, but understand if we have a watch list that maybe some of the stocks that haven't hit our buy prices on the longer time frame, they might get flushed into those as well. So I think a perfect example of this, I'll give you two examples. One was Apple. And so in the case of Apple, here's a longer term chart. And you can see after it reported earnings, it gapped above 200. It consolidated for about a week. And it was being accumulated during that week around $207 a share. So when when the market started to get weak and Apple wasn't breaking down from the 215 area, I said to myself, if the market really flushes and Apple can come back down to 207, 208, that's going to be a good spot to potentially get involved. What I loved about it yesterday was when the market was selling off from the mid 260s and started to accelerate to the downside, Apple was still around 212, 213. And as the market flushed into 260, Apple actually got down through 207. You can see very quickly reversed and was back up at 212. The reason why you have to have your bounce list ready to go is you have to, either have your alerts down there at 207, 208. You have to have a script down there ready to buy. The one little tidbit I'll give you is if it wasn't set up like this where it came from 212, 213 and very quickly dropped $5 into the market flush, let's say, for example, earlier in the day it had been weak and was consolidating at 208.50 or 209 and the market flushed down, I'm going to be much less likely to look to buy this because there's a greater probability that it's going to flush through the support area and keep going. But it was set up really well. It was being accumulated in the 15, 16 area the last couple of days, was down around 212, 213 into the afternoon. And then when the panic set in, you had a lot of room to work with from 212 all the way down to 207. So it was likely people would come in. And what happens in these situations when you buy, you want to see within 10, 15 minutes it get back up to where kind of the breakdown started from. If it doesn't, you want to really aggressively sell. The other example I wanted to give you was more of an industrial type stock, another one that I got involved in yesterday. Second time I've really bought it in the last 6 months. The first time was way back in March, April when it flushed below 320. Then on the higher time frame, what I noticed was over the recent months, it had quite a bit of support around 330, just below 330. I highlighted both in the summer. It held right there, about 328 to 330, went up to 360, came back, did a retest in August when the market was weak, I guess, touched that 330, then made a new high. So the stock actually was, hanging out there in the 350, 360 area a few days ago and had alerts ready to go at 330, 332. And so when it flushed into it, when the market was tanking yesterday, it came into 330, ready to go. Buy it there, it immediately popped $5 or $6, so was prepared to take it out as an overnight. Today it bounced about another $15, $20 or so. The one thing I'll say about this one too is if you missed the flush, like into the close yesterday at 330, this morning it dropped out to 330 again, so you had a chance to get there again. Quite often, not every time, but quite often, something will flush into the close, bounce a little bit. In this case, it bounced about $6. The next morning, if the market starts to sell off, you may have a chance again to buy it into the prior day's low, which is always an easy thing to do. You know where your out is, half of an ATR below the prior day's low. You know what the bounce is, back up to the mid 340s. So those were two examples of always be prepared for a flush. The prices that we wanted happened when we got the flush in the market. And then the final tip for you in a dangerous market, in a volatile market, is have the exit ready to go before you enter. And the reason for this is when the market's moving extremely fast, sometimes you can be a deer in headlights. You have a lot going on, you have a bunch of positions, market's moving up really quickly, it's moving down really quickly. Understand exactly before you get in the trade, this is so important right now. In a slow moving market like what we had in 2017, or what we had from May of 2018 all the way up until really through Labor Day, until mid-September or so, you can kind of just take your time, work your way into the position, work your way out. In a market like this, where the market itself, let's take the SPYs for example. The SPYs, for example, really were not moving even 1% intraday up until things started getting going in October. Now, on a daily basis, really in the last week, if you look at the down and the up moves and the SPYs, we're probably moving, I don't know, 4 to 6% intraday, 5 to 7%. Sometimes on the really busy days, like yesterday, maybe even 8 to 10%. And so you have to just, there's great opportunity, but at the same time, if you don't cut yourself off quickly on a loss, a small loss can become very big. You're done for the day, and you miss this huge amount of opportunity. Think about that. We weren't moving even 1% intraday for a long period of time. Now we're moving baseline 3 to 4% intraday, and on the busier days, 5+. That means if you keep your losses small, you're going to have the opportunity pretty much every day to have a big day, and you don't want to get stopped out. So here's an example. I'll give you 2 examples from today. And by the way, before the day starts, I want to understand where potentially I'm going to be short the market, where potentially I'm going to be long the market. Coming into today, I knew 260 and 6.5, 267 could be a problem. If we failed there right on the open and we came in to 264, which was actually my support area. So I knew if we ran back up there, above 266.5, I could look to start to get short, and I knew above 267.30, I was out, I was done being short, I would start to look to get long again. So good example, it worked, we popped back up there, we failed, we came back down, I think to 264 again. The exact opposite was later in the morning. After capturing that failure at 267, I'm looking to get long at 264. I had 264 as a potential area we'd support on the open. We supported there, went up a few dollars. We came back in, we went up a few dollars again. When we came in again, I looked to get long there, came into 264. We actually did pop $1 there, but then stopped out. You got to take the stop. I don't know when it takes out that morning low if we're just going to keep going. Maybe we'll go down to 262, which was kind of my next support area, or the flush low from the prior day of 260. You got to get out if it's not working. The one thing I'll say is that trade is a scratch really, because it did stop there initially and popped $1. Take 25, 30%, or even 50% of the position off, trail your stop. That way, worst case scenario, it's a break-even trade or a small loss, small gain. But you got to know when you're getting in there at 264, 264 and a quarter, you're out below 263.70. No ifs, ands, or buts about it. Because you don't want to be that person who's, hitting out at 262. You're down too much money. You're done for the day, and then you miss the next up leg. So those are our 3 tips for today. To quickly recap for you, they are: have a bounce list. Update your bounce list every few days. Look at the longer term, look at the 30-minute, 2-week chart, look at the daily chart to find the areas potentially to bounce. If the first area doesn't work, give you an example. Netflix bounced $15 from my first bounce area. Then it failed a couple of days later, next 275. Now it bounced again, $13, $14 from this next bounce area. We want to keep with it, so eventually we'll catch the bigger move. The idea is on these hard sell-offs in the market, if you give it a few tries, not only can you make money intraday, but if you don't get stopped out of some of your position, you can catch that larger 15, 20% move with the market as the market starts to turn and have a larger move overall. Always be prepared for a flush. A flush basically is when the market's moving down, and then there's just a very fast dropout. This tends to happen in the first 90 minutes or the last hour of the day, usually. It can happen at other times, but it's most common right on the open or closer to the close. And just be ready for it, mentally prepared for it. And then finally, understand and know exactly where you're going to get out before you get in. These 3 things, invaluable in a very volatile market. They're going to help keep you in the game longer during the day. You're going to make more money if you're in the game, and that's what we want from everybody on the desk and all the people who are following us and watching our videos. Thanks, and hopefully there was some good stuff for you.